It's a pleasure to present today their work that has been part of my research agenda for a while now. And I would be happy to hear your feedback on my work as well. So anytime during this presentation, please feel free to ask your questions. You can unmute yourself and pop in with your question. So the work that I'm going to talk about today is titled as The Impact of Open Source Community on Cryptocurrency Market Price and Empirical Investigation. And as it is seen from the title, it is an empirical work. It is also a joint work with my co-advisors, Professor Nectate Shu and Professor Kevin Padak from the University of Florida. So before I delve into the details of my study, I would like to briefly give you an overview about myself and my career path. I have got my PhD at the University of Florida, ISOM department, Information Systems and Operations Management department, where I actually started in being interested in the topic that I'm going to talk about. And after graduation, I have joined George Mason University as an assistant professor in the ISOM area as well. So I'm pretty much focused a lot on the technology and how it transforms the business environment. And that gave me pretty much the understanding of how I would title my overall research agenda. So overall, I am interested in the new technologies and how they transform existing business models. One of the key streams in my research currently is the blockchain technology and how it transforms the economic environment and the business environment. There are several projects that I'm working currently within this stream of research. The first work, which I'm going to talk about today, is covering the impact of open source community on cryptocurrency market price. I also have the work that explores the informational efficiency of cryptocurrency market from the point of view of regulatory different measures that are applied to different crypto markets. And also within this stream, I also expand my interest towards other crypto technology or like other types of crypto tokens. So in particular, one of the latest working papers is focused on the NFTs and the economic dynamics within these non-fungible tokens. Beside the blockchain technology, which definitely takes a lot of my interest and a lot of my attention, I'm also interested in other technologies that are changing business. And one of them are real-time applications in general and mobile applications in particular. So within that second stream of research, I have some work that covers the real-time feedback applications and how they are being used in organizations to provide feedback between employees. And we are looking from the network perspective on those feedback exchanges in real time. Interesting paper, you can find it at ISR currently just by Googling my name and you will see it there. Within that same stream of research, exploring further the real-time mobile applications, we continue the work in the different context, in the context of the automotive industry and how this technology helps to improve the service, in general, service for the clients. Besides these two key technology stacks that I mentioned earlier, I'm also broadly interested in the topic of the digital literacy, and the technology is currently present in everyday life. So I came across this idea of thinking how we can enhance the digital literacy, and some of my work is essentially targeted towards that, to educate more on technology. I also apply a lot of social network analysis in my work. So as you can see from some of my papers, the social network methodology itself is of great interest to me. And broadly, I'm also interested in other types of digital platforms and technologies. So first, I would like to give you a short summary of the paper if you have to jump out of this meeting before it ends. So I am going to talk about the cryptocurrencies, and I will offer the unique new view on them as a software project. I will talk about the effect of software development effort on the market price of the cryptocurrency. And lastly, I will try to explain my findings using the signaling theory and how the OSS, open source software activities, can be used as signal to evaluate the crypto projects, help the investors make their decisions about investment, and how this approach can be used by a regulator when tailoring the proper information disclosure policies for the highly technological projects such as cryptocurrencies. So briefly, I will break my presentation into several stages. First, I will introduce you the topic of my study. Secondly, I will try to motivate and hopefully convince you to extend your mindset of looking on cryptocurrency as a software project. Next, I will talk a little bit about the theoretical underpinnings of my work, followed up by the brief literature review of what works can be used further to investigate this direction. And next, I will discuss the empirical part of the research. I will shortly talk about the data setting and data sources that we've used for our empirical study. I will highlight the main results, and will lastly talk about the implications and contributions. And again, just reminding you that if you have any questions during this talk, please feel free to jump in and interact. So when we speak about the cryptocurrencies or blockchain in particular, or blockchain in general, the first thing that comes to mind is like what is happening there on this, it was the dynamics of the prices. So it is always seems of great interest for people, but at the same time, it may seem sometimes confusing. Like how do we, in general, treat this market? How do we follow it? How do we understand what are the drivers of those market changes? So briefly, I would like to illustrate this dynamics of prices. This is the price of Bitcoin for the past 10 years. And as we can see that there has been a lot of volatility in the market, and the investment pool of investors has increased largely since its initiation, the starting of Bitcoin. However, when we look at these prices, we always want to make some informed decision. If our goal is to invest in these cryptocurrencies, we want to have some base, like some information of which we can reliably use to probably make our decisions more informed. So, and with that context, the main question for us is that what indicators shall we use to understand the crypto prices? What is that ground truth that we should look into so that we can at least make some inferences about where this whole market can go further? So guided by this question, actually the academic community has came up with a lot of ideas and tested a lot of hypotheses. So in this slide, I will briefly look over how different researchers have approached this question. And I'll remind us, the question is like, what factors influence the price of cryptocurrencies? So the first stream of research and initial idea was to, again, gauge the prices of the crypto assets, such as Bitcoin, Ethereum, against the more traditional macroeconomic indicators. And the early studies in this area, they have looked at various factors such as income growth, the prices of precious metals such as gold, silver, major cryptocurrency prices, major currency prices such as price of euro, dollar, Japanese yen, market indexes such as S&P 500, and the prices of some main commodities categories, in particular energy commodities. So the early work has looked at the pretty much correlations between the prices of cryptocurrencies against these different macro indicators and tried to conclude with what indicators the cryptocurrency prices have a similar movement. And the general outcome was that at early stages, the prices of cryptocurrencies were not aligned with these major macro indicators. So then the researchers started thinking, well, maybe the crypto resources, such in particular Bitcoin, are the safe haven that we can hedge our portfolios and invest in Bitcoin. But the further cryptocurrency market evolution has proven otherwise. So as the market—
Can I ask a question?
Sure.
I just want to clarify them, because I think that for some people, maybe also for me, the definition of cryptocurrency, it's very big. So do you want to maybe a little bit go down and say which kind of cryptocurrency you speak about? Because I guess that it's not about stable coins, because they are digital assets, but they are, I guess, not with this fluctuation. And also, I guess, so it's more about like, I think people call it native tokens like Ethereum, Bitcoin, which are cryptocurrencies, which also have their own blockchain network. And this is what you have in mind when you, like, this is the goal of like explaining this kind of type of cryptocurrencies, or it's something like just if you can like say something about it.
Sure. Well, great question, Nir. Thank you very much. I should have mentioned it probably from the very beginning, that by cryptocurrencies, we mean that it's any digital asset that resides on top of the blockchain. And of course, we're not speaking in particular about the stable coins, since, I mean, by design, the fluctuations of prices are minimized. However, one point that I wanted to bring in when we talk about at least this literature here, this time period, to my best knowledge, the stable coins were not there yet, like 2016, it was too early for that. So it was not an issue per se, because like the prices of all cryptos were fluctuating. But again, for the purpose of our analysis, we're talking about any digital asset that resides on a blockchain and which price is fluctuating. Yes. I hope it answers your question.
Yeah, perfect.
Thanks. So moving on, the researchers have shifted their views on the further areas of exploration. And I grouped these studies into two further streams, where the second stream was looking at the cryptocurrency, was essentially attempting to build some sort of evaluation model for the cryptocurrencies. And they shifted their attention from the more general macro indicators to more specific factors relevant to cryptos, such as the mining technology, mining difficulty, computing power, cost of electricity, and availability of electricity. So these are undeniably the factors of production of new coins, and therefore they somehow should be factored in when we're trying to evaluate the market performance of the cryptocurrencies. So from that view, again, just following already the knowledge that was accumulated in the finance, econ areas, the third stream was looking at the behavioral aspect of cryptocurrencies, such as the social interactions with them. And the early studies have, or as early as 2018, they have looked at the various discussion forums about the different cryptocurrencies, and were pretty much trying to investigate how the public sentiment correlates with the market price of different cryptos. So I see you're nodding, so I'm pretty sure that you're familiar with these streams. One thing that when looking at these different studies, that is quite clear that from the get-go, we started thinking about the cryptocurrencies from the financial asset approach, which is quite logical and reasonable because they are publicly tradable assets. We can see all these fluctuations. So it was natural that we would adopt this first point of view. But when we started thinking about this phenomenon of digital assets, we also started pointing attention at the different project descriptions. And typically when we search through different cryptocurrencies, they try to somehow differentiate themselves from other projects, such as differentiating by applying different technology, by promising the different governance structure to the investors. So it led us to these ideas that we know already that we can treat cryptocurrencies as financial assets, but how about we factor in that these projects are differentiated? And we started thinking about the cryptocurrency as pretty much any other product in the market that is differentiated by its different characteristics. So in this slide, I will list a couple of characteristics of cryptocurrencies that we were considering when coming up with this differentiation concept. So the first thing we know about cryptocurrencies that they are not grown or mined as commodities, which was another alternative thinking about cryptos as commodities. But the commodities are either mined or grown, so essentially we cannot impact the supply of it. So, but cryptocurrencies are created. They are being programmed by the software code. Then the new coin issue is governed by the algorithm, and each cryptocurrency may have the difference in this algorithm. So investor gets to choose what algorithm is more appealing, more amenable towards their investment strategy, or if they try to participate in the governance, then they also can choose based on this characteristic of an issuing algorithm. The other differentiating characteristic is the limited supply. So we know that different cryptocurrencies, they have either limited or unlimited supply. And when it's limited, it also is limited from 42 tokens in 42 coin or to 21 million tokens in Bitcoin. So these all were these design decisions projected by the designers of the cryptocurrency, and they differentiate one project from another. So going forward, the different cryptocurrencies, they also reside on different blockchains. And by blockchain, we mean the underlying technology that enables this decentralized network of and transactions and token exchange. And lastly, but not the least, one of the key components of the whole thing, the whole idea about cryptocurrencies is the cryptographic algorithm. So cryptographic algorithm, hence cryptocurrencies, and there is a variety of cryptographic algorithms that are being implemented by different crypto projects. And depending, for example, on the privacy preferences of the investor, they can also lean more towards either of these cryptographic algorithms within the cryptocurrency project. Are there any questions so far about any of these concepts.
So, because because you give us the introduction in the beginning that you are kind of want us to think that it's kind of a software. So I just want to see, based on these slides, so it's kind of, I can think that also if I want to buy let's say a stock of tech company, and I know that each company also has a different kind of technology and this kind of aspect. So in some sense, like in your point of view, assets are also kind of a software.
So that's an interesting question, and correct me if I'm wrong. This we developed this thinking because they are being traded on these electronic marketplaces. But the difference between the, let's say, traditional stocks of Tesla or Facebook and the cryptocurrencies, that when evaluating the stock of Tesla, if we do the fundamental analysis, we're trying to evaluate the operations of Tesla as a company, right? So in the fundamental evaluation model of traditional financial assets, we are taking into account those like cash flow indicators, the operational efficiency, debt to income ratio, or whatever other indicators we are including. So with that regard, we cannot exactly tell that traditional stocks are also programmed by code. It's just happened to be so that, currently we are trading them on these electronic marketplaces, but that's not the key characteristic of the traditional stock that they are traded electronically. Does it respond to your question?
Yeah. I see your point. Like you say, like Bitcoin, it's not like Tesla because you can see or every quarter the cost and benefits analysis and how many workers and how many production. So you have no these facts to evaluate the price of Bitcoin in that sense. So you need to use a different model. Yeah,
Exactly.
I can see, but I also see like some other aspects that are equivalent, that it's some sense when you hold it, you can think about holding it as a technology, same as when you hold the Facebook stock, you have some beliefs about the technology and how much you believe that it can be useful in the future or not. Yeah, but yeah, it's not apple to apple. I see your point.
Yeah, great. And I'll also be talking a little bit more about this evaluation approach for cryptos in the upcoming slides. So again, just to recap this, when we try to identify these differentiating characteristics of cryptocurrencies, kind of like cryptocurrency to cryptocurrency, and also we essentially compare it, what differentiates cryptocurrency versus the stocks. We understand that there is a lot of characteristics that are actually related to code and to the quality of this code and the quality of technology. So I will come back to my main point here, is that by looking at these different technologies, these different characteristics, we clearly can see the difference, let's say, between Monero and even like Bitcoin. They use different stack of technologies. So they essentially, when we are investing, we can also choose based on the stack of technologies, right? That's similar that when we choose which app to use for a particular purpose, let's say for our team communication, we have like all these types of messengers, WhatsApp, Facebook, Messenger, Slack, etc., Discord, and we choose based on like what technological features they offer to us. So similar here, we're choosing, one of the types of how people choose is what does this project offer to us? And in this case, it's technological offer. So when we look at the market of cryptocurrencies, there are really, it exploded, and there are thousands of these crypto tokens, crypto coins, generally crypto assets. So the question here comes, like, when I am entering the market and I'm trying to invest, how do I separate the good cryptocurrencies from the bad cryptocurrencies in terms of the investment results of them? So this question of separation the good ones from the bad ones made us thinking, what are the possible characteristics that will signal us about the quality of the cryptocurrency? So in our research, and I've been looking at this topic for quite a while now, and especially in the early era of the cryptocurrencies, when there were below 1,000 of them, a lot of discussion was happening around its software development. So the early adopters, they were also puzzled with these questions. How do we choose which cryptocurrency to invest in? And that was in the era even before cryptocurrencies received much exposure, or no companies were like publicly claiming that they're investing in certain crypto. So all that social media buzz was not there yet. So those true first adopters, they were looking at the cryptocurrencies from the software perspective. And they pointed their attention that the quality of code actually matters for crypto. So cryptocurrency is a digitally native kind of like development, meaning that it emerged from the internet by using these advanced technologies, cryptography, etc. So essentially the first adopters, they were also very savvy, technologically savvy, and they were the first one to point at this approach, that cryptocurrency is a software and they are differentiated by the quality of their source code. So this was, as I mentioned, this was like the very powerful sentiment at the, let's say, like in the mid-range perspective of the lifetime of cryptos. But now what we observe now, it actually is coming back to that notion that we need to factor in the crypto developers and their opinion when we are speaking about how do we treat cryptocurrencies. So you all know about the recent president's order for the responsible development and adoption of the crypto assets. Followed by that, actually the senators have introduced another proposition of a bill for crypto legislation, where in the text of the bill, they explicitly mention the crypto developers as one of the major group of stakeholders. And taking it further, they actually published their bill on the development platform, so that developers, users of this platform, can provide their feedback on the legal act that they put together. So with that, yes.
We have a question from Yang in the chat. Can you see it, or you want me to go over it?
In Q&A, right. So the question sounds like, does it mean that we are evaluating the codes of the project? For example, if we are looking at the potential bugs. So I would want to say that generally, yes, but we're not evaluating the codes per se, but in the framework that we are working, and I will discuss it in just a couple of slides from now, that this development platform essentially has all the characteristics of being like a social platform, like an Instagram or so. So we can see different types of activities aggregated. So we're not digging into the code. We might not have like, average investor may not have that expertise of like reading the code written in Solidity or like any other programming language. But what we can see the behavior of developers who contribute to project. And partially, like answering your second question, we're looking at how much bugs have been reported. So in some sense, the bugginess of the code, we also take it into account. I'm not sure if I asked your question fully now, Jan, but I will talk about it in just a couple of slides from now in more detail, what indicators we're looking at.
And I have a related question, because many stuff are open source, so it's very easy to copy paste. And I think during 2020, there was a big initial coin offering of which in some sense, most of them, I guess, was copy pasting of the code of how to create these tokens, but each token was a kind of a representative of people who want to invest in a project. So basically, the idea was that if you have a technology and an idea, so you come to the community of the blockchain and you say, okay, I'm selling you these new tokens, let's say NEAR tokens, and I want you to purchase them, and I'm going to say to you that in the future, this token will be, that mean that you are part of the NEAR project. So it was a way to fund new technologies, but the idea is that many people that want to do this just copy paste the same code. So in that case, I guess that so the other aspect going to influence the difference between the differentiation between the tokens, because the technology of the tokens will be the same. Just like there is a difference between NEAR token, Kite, but it will be different projects that you want to invest on. Does it make sense?
Yeah, I think it's, I understand what you're talking about, that it's in an open source environment, it's fairly easy to just copy someone else's code and pretty much enter the market fairly easily, right? That's what you're saying?
Yeah, but I think it's more common when your goal of the token is for generate funds. So that's why I mentioned initial coins, because in that case the technology is less important of the token. It's more about the what you offer as the project that the token will be part of. And in that case, I think because when you create a blockchain network like Solana, so everything is rely on the code and the system. But you see, so I'm speaking about a very specific group of tokens.
Okay.
But we can speak about it later if you want.
Yeah, let's continue probably with the discussion, and I will introduce, I think that when I'm talking about the data setting, I will answer your question. So if we can hold off towards that moment. Okay, so observing this conversation in the crypto adopters community actually led us to thinking about, to looking essentially, how does the activity in this project, development activity in this project looks, and what we can make out of it. So as I mentioned earlier, this whole conversation, they bring us to this understanding about the cryptocurrency, as on one hand, it is a software that undergoes the significant development effort. And on the other hand, it is easily can be treated as a financial asset, because it is traded publicly. It has some sort of active trading effort going on. So we are trying to embrace this duality in our paper, and look at this phenomenon of cryptocurrency from this both perspective to connect them in some way. And also this thinking guides us in thinking about like evaluation models. So previously we have talked about that for traditional financial resources, for traditional financial assets, such as stocks, we have the set models, how we evaluate the investment potential for it. We have this model that is based off the cash flow, and that is how we evaluate. So for cryptocurrencies, we don't have the cash flow model, or so to say, cash flow model, which is common in traditional finance, is not applicable because cryptocurrency, first of all, it is not incorporated. We don't know what the organization, where are the boundaries of that operations of the company. And secondly, we even don't have enough information. There is no reporting requirements, and all different projects, even when they release some information, this information may be very versatile across projects. So there is, so to say, there is no common standard of information based on which we can observe, based on which we can create this new evaluation model. But what's common across all these projects is the source code, and we can observe the development activity in each of these projects. So that's something that is common, observable, and it motivates us to explore it more as one of the potential indicators for the evaluation model of cryptos. So as I mentioned earlier, when we speak about the cryptocurrency literature, it is mostly focused on the price component of it, on the finance part of it, and clearly ignores the software part of it. The traditional open source software literature, it is purely focused on the software part, and due to the lack of the monetary evaluation indicators in open source software, it is silent on the price software effort connection. So in our paper, we are trying to connect these two streams of research and build a bridge between the software effort and the monetary evaluation of the software products such as cryptocurrencies. So now I'm going to talk about a couple of questions that are typically arise when thinking of this framework. So the first one is, why do we look at the cryptocurrency prices at all? In the finance literature, we know that a lot of market assessment is based off this concept of the efficiency of the markets and efficiency of the prices of different assets. And this concept of efficiency of the financial market is crucial for the optimal allocation of resources. So essentially what the efficiency concept means, market efficiency concept means that the prices already incorporate all available information about the financial asset, and there are very limited opportunities for informed trading, or ideally, no informed trading can happen in the fully efficient market. And there are a lot of mechanisms developed for that. One of them is the legal requirement to report and disclose all the information. That's how we can know all those cash flow numbers and build essentially the evaluation model for traditional stocks. And this is not a case in cryptocurrency setting at all. Until now, there is still no legal requirement or no even industry standard that would govern how these different projects, cryptocurrency projects, disclose the information about their operations or their financial results or whatsoever. So this concept of informational efficiency of markets in general becomes very important when we want to protect the market participants, individual investors, from the risks, because having the imbalances of information between different group of actors, informed and uninformed traders, it can create advantageous situations for informed traders, which will lead to losses in the other group of investors. So again, this question is quite incorporates a lot of aspects, and probably the top layer of it is what do we need? How do we need to build our information disclosure for this crypto project so that we can create equal opportunities for everyone to trade and avoid this all, pretty much all these stories about how some groups of investors have insider information and can trade and gain immense profits based off crypto. So on the other hand, we're also looking at the source code and as one of the potential sources of this information to cover that gap between the informed and uninformed traders. And the idea is very similar to the traditional finances. So in traditional finance, we have observable factors such as sales, revenue, capital structure, debt structure that indicate about the ability of the company that issues stocks to generate cash flow, to be efficient, and based on that, we invest in this in the stocks. So these indicators are called not crypto, but the fundamentals, the company fundamentals. And what are the fundamentals of cryptocurrency? Of all available indicators that we know, one that comes to mind is the source code, which is, as I mentioned earlier, is available across all cryptocurrencies. So it intensifies our attention towards this aspect of cryptocurrency. And in the software literature in general, information system literature, which focuses on the quality of software, one of the indicators of the quality of software is the amount of development effort. So this relationship does not necessarily have to be linear, but the fact that there was some effort expanded into building the code, fixing the code, debugging the code, actually signifies a lot about the quality of this code and how the software product will be functioning in the later stages. So following this framework of the development effort as an indicator of the quality of the software, we develop our research framework. So we are trying to connect here the development effort to the market price of the cryptocurrency. And we apply this signaling theory to explain our empirical findings. So how would we do that? Essentially, that development effort signifies the quality of a software. And by observing these proxies of the quality, we can get some signals about the quality of the cryptocurrency as a software product. And in the market where we have a lot of crypto alternatives, we, of course, would want to pursue those who are more reliable or of a higher quality. Hence, the higher quality of the cryptocurrency, the higher attention it will get from the market, more investment will be made in the particular crypto asset, and hence the market prices should also reflect this increased attention and increase in general. So that's our underlying theoretical framework that we are using here by treating development effort as a signal of the higher quality, which leads to higher market price.
So I have a question.
Sure.
So when you speak about development effort, there is a question about maybe quantity versus quality. So we're speaking about that we have an open source, and we have a lot of developers are involved in the code. Let's think about Ethereum economy, community, whatever. So how you like how you calculate this effort, because it's how many changes there are in the code, how many unique programmers are involved, or what I need to think in mind, like.
Yeah, I think that I held off that question for too long, like postponed that information for too long. So let me just quickly announce my research questions, and the next slide, I promise I will talk about those indicators. So our first research question in that announced framework is to understand how development activity impacts the market price of cryptocurrency. Pretty simple and fairly straightforward. And next, since we're talking here about highly technological projects, we're interested to understand what are the moderating effect of technology here, because technology can require more or less development effort based whether it is more innovative or less innovative. So we're trying to understand that moderating effect as well. So data setting here, answering all the previous questions here. We are using the market data from the CoinMarketCap, which is the average, weighted average daily price for each cryptocurrency in our sample. And the open source or development effort we collect from one of the biggest open source software platforms, GitHub. And it is interesting that over 70% of cryptocurrencies, they use the open source software platform, and the GitHub in particular. And the rest, they either are closed source, so we cannot see their code. So those are apparently not in our sample. And the others who use the other platforms, they are in minority, like less than 5%. So we're focusing here on the GitHub, which is the major one. And if you're not, yeah.
Sorry, can I understand? So here 70% is that, let's say there's 100 cryptocurrencies, 70 of them have open sources. Do we know something like the market share of these 70% of cryptocurrencies? As in like dollar terms, like that? Would that be the majority, like the majority activities in the cryptocurrencies would be these 70%, or let's say Bitcoin would be not in this 70% category?
So great question. Thank you, Kyle. I wouldn't give you the exact answer, but Bitcoin and Ethereum are open source. So you can kind of like decide for yourself if that covers the significant part.
Got it.
In my opinion, yes. But again, I don't have the exact number in terms of market share, like market valuation. So if you're not familiar with GitHub, it's essentially the collaborative platform for developers to access the code and edit the code simultaneously. And it is very similar to the known Google Docs functionality, where we have a common document that we share among co-authors, and we can contribute to it, make comments, make changes, make copies, etc. So fairly simple to Google Docs. So now the GitHub platform has its specific functionality and has certain metrics that are defined as the most important ones to track in the open source setting. These are 5 types of activities that we are considering in our analysis. These are commits, pull requests, issues, forks, and watches. So I'll probably won't go very much into detail. Some definitions you can see on this slide. But what I want to talk about is another artifact that we developed, is that these activities, they come from appear from different motivations of developers. The first 3 activities, commits, the one-time change, pull request, the proposed change that needs wait for approval, issue is the suggested improvement. So no work, but detected problem or recommendation and suggested. So these 3, they come from the perspective of the improvement of the quality of the software code. So it's purely based off the current state of the code and what is the next iteration of the state of the code should be. So based on this logic, we treat these three types of activities as the signals of quality. The other two activities, such as forks and watches, they are purely social based. So forks is the copy of the initial source code, and watch is like a subscription or like a following activity on social media platform. So based on this, the social nature of these other two activities, forks and watches, we treat them as the signals of popularity. This will be like two groups of signals that I will be further operate when talking about the empirical results. So a couple of visual interpretation of the data that we are working with. One of the key things here that I want to point your attention is the upper right chart is the monthly aggregated dynamic of open source activity. It clearly shows that there is quite good dynamics in it, and there is some volatility, periods of ups and downs. So it allows us to match this, having enough volatility in this data allows us to match this data versus the price data again. And at the bottom part of this slide, you can see the summary statistics for each of the key metrics in our empirical analysis. And what I wanted to point your attention here is the last column. This is the number of each activity calculated per day. So it means what we observe here, for example, that every day there are at least 2 commits on average. Every 2 days there is at least 1 pull request, at least 1 issue every 2 days, 1 fork at least every 3 days, and 1 subscription at each 2 days. So it means it gives us a notion that the contribution is quite frequent. So again, this is just gives us more reassurance that we can use this data because it is highly dynamic as well. I mean, open source activity data. So moving forward, I would like to bring us closer towards the main results, answering our first research question, how different types of development activities impact the price of cryptocurrencies. We put together the fixed effects model, and I would like also to mention that we have a panel of 500 cryptocurrencies across the period of August 2016 to August 2018. So it's quite substantial period, and this is the monthly aggregated data. So in this case, our dependent variable is the logarithm of price. And since it's a monthly aggregate, we take the price at the end of each month. So it's last day of the month, that is the price point of that serves as a DD. On the right-hand side, we see the set of our development activities, and these are grouped, aggregated for the whole month. So, and by construction, the number of commits for the project I in month T is the aggregate of commits from day 1 to day 30. And the price point for the cryptocurrency I in month T is right at the moment when after all these commits are done. So this again, this construction of variables allows us to address that problem of the reverse causality, which I will talk a little bit more in the future slide. We also include several controls that we have available in our data set. These are the trading volume to account for the market factors, and also the lifetime of a coin to account for this natural evolution in also the growth in size of developers in their activity, and also the market price, how it evolves over time. And we control for the time effects by including the monthly dummies. And essentially the fixed effects will account for other characteristics of a project that are not accounted by either of these variables. So when we ran our first model, we obtained the following result here. So we observed the negative and significant coefficient of commits, which I remind you is the metric of our quality. We observed the positive and significant coefficient of forks, and as well as watch events. So with these results observing, we see that the quality signals actually are negatively associated with the market price. And one possible explanation for that is that when we observe that there is a lot of work going on for some project or for some product, we may infer the lower quality of the project. So it is very bad right now, so it needs a lot of work. Hence, we will have a negative sentiment towards investing in this crypto, and hence the price will go down. On the other hand, when we are observing that other people are actively engaging with the product, reusing the code or using the code to further improve the code of the crypto, or they just interested and they subscribe, they want to stay updated with all the updates in this community, then our sentiment shifts towards more positive attitude. And hence, the popularity signals are positively associated with the market price. So what we show with this first type of analysis is that indeed there is a connection between the OSS activities and the market price. And we explain this connection by using these signaling properties of different types of the OSS activity. But reasonably, when looking at this type of analysis, we can also think, well, won't the price stimulate more development activity? Won't the higher price attract developers to contribute to a project? So the concern of the reverse causality appears, which we try to alleviate by using the following empirical approach. We are constructing 5 instrumental variables, and they are constructed in the following way. So for each project, we take the set of developers who contributed in this month, and we compute the aggregate activity of these same developers who contribute to the focal project, but in other OSS projects on the platform. So essentially, we want to construct our IVs in such a way that they are related to the focal GitHub activity. And our IVs are related because if we assume that one developer has a same propensity to contribute or not contribute to OSS development in a particular month, then we assume that if they contribute, they will kind of like contribute with the same rate to different projects. Hence, our IVs are related to the focal GitHub activity. And on the other hand, the IV should not affect the price dynamics of crypto, which is satisfied as well in our case, because let's say the developer who contributes to Linux product, his contribution to Linux does not affect the price of Bitcoin in any way. So therefore, we follow on with using these 5 IVs that I just explained how we construct them. And by reevaluating the model with these IVs, what we actually see the consistent result of our popularity signals, which is significant and positive in this case. So I'll just name them again. These are number of forks and number of watches or subscriptions. They're positively associated with the price increase. And within the quality signals, which are commits, pull requests, and issues, we observe that there is some heterogeneity. So previously, we observed that pull requests have commits were significant, But when we apply our IV, we actually see that the pull requests become more significant. And one reason for that is that pull requests essentially are the changes to the code, but which have to be accepted by responsible developers. So in this case, pull requests, they more precisely identify the willingness of the people to contribute to the software code and to fix it, because it is unconstrained contribution, versus commits. These are already selected and approved by the core developers. So in that case, we see that we actually lean towards using the pull request as a more precise metric of this quality of the software code. And the negative sign is explanation. It's consistent with what we've seen in the commits part of it, that the more contribution is observed to fix the code, the more negative is the perception of the current quality, and hence the willingness to invest drops and the market price drops down. Yeah. And on the contrary, with the issues, which are then suggestions for future improvements, or which which consist of both the bug reports and also feature requests, it has surprisingly positive effect. And one of the possible explanations is that typically people would write an issue if they want the product to change, and it means that they are intended to use it in the future. So in some sense, it also serves as a metric of adoption. So therefore, the higher the signal of adoption of a particular software, the higher will be the sentiment, the more positive will be the sentiment about the quality of the cryptocurrency software, and also the sentiment about the growth of the market price. So I'm not sure how good we are on a timeline.
We have about we're about to running out of time, but we have like, let's take maybe another 5 minutes to conclude, or
sure.
If you...
Sure, I will wrap it up, but just mentioning that in the process of the review, we've encountered a lot of comments and feedback about all these empirical issues, and we definitely admit that the setting is not exactly amenable towards like writing through it smoothly. So we applied a lot of robustness checks. One of them is the panel VAR model to test for reverse causality and actually to see what the results would look like. And the results that we've obtained from this autocorrelation and like panel VAR model are satisfying, and they are robust with our key findings. And our key finding is essentially, our key purpose and key finding is that to establish the connection between the OSS development and the market price, which is confirmed by either type of analysis that we do. In addition, we also do some other periods of aggregation, which also deliver the consistent and robust results, include some other macroeconomic factors, which also confirm that the main findings of our main model, IB model. I want to go over the technology results very much in detail. And I just wanted to mention that hopefully you will be able to access the paper and read it fully once it finishes through the review process. So a couple of practical implications and conclusions for the end. If I were to again remind us about one main thing that we've been trying to do, we've been trying to point our attention towards this underexplored aspect of crypto project, such as its software nature. So by showing that there is a consistent connection between the open source software contribution and the market price, we kind of like show investors one more way how they can evaluate crypto projects. And that's interesting because it is never have been spoken loudly or like obviously, but all these crypto listing platforms, CoinGecko, and many other platforms, they have this tab, dev activity, where they post actually the dynamics of the contribution. Yeah, so we pretty much with our results, we try to guide investors how to use those metrics as well. So signals of quality have the heterogeneous impact of market price. We observe the positive and negative depending on the indicator. And forks and watches, which are signals of popularity, they are definitely positively related to market prices. And lastly, but not the least, about our contribution. So the contribution is fairly straightforward. We are covering the gap, which is currently existing in the literature, between two views on the cryptos, which is the financial asset view, which is quite strongly represented, and the software view, which is underrepresented. So we try to build a bridge between this IS and finance aspect of the crypto research and show the impact of development activities on the market price of digital currency. Thank you very much. And if you have any other questions, feel free to contact me, and I would be happy to keep the discussion going.